Okay, I have 10:31. I think we're going to go ahead and get started with our next session here. Thank you everyone for coming. This session is Carbon and Ecosystem Service Markets, What Farmers Should Consider. My name is Jorgen Rose. I'm the Habitat Program Manager for Practical Farmers of Iowa. I'll be moderating our session today for our featured speaker, Dr. Alejandro Plastina. We'll be together here for 60 minutes, followed by lunch on the 200 level, one floor up. If you purchased a lunch ticket, you should have it on your name badge. If you need to purchase a lunch ticket, you can do so on the 200 level. Information about the food sourcing is on page 9 of the conference program, so please check out all those local food producers that we sourced our food from. If you are a certified crop advisor and intend on earning CEUs for this session, we have a sign-in sheet somewhere over there. Look for the blue tent. Just a note on civility, please be mindful that we are a diverse group representing many perspectives. Please be generous with your questions, respectful with your comments, and uphold PFI's core value of providing a welcoming space for everyone to learn and share about farming and agriculture. Evaluations, please continue filling out your evaluations on page 39 of your program. Hopefully you've been filling those out as you attend sessions throughout the conference. Please remember to turn those in at the first floor at the end of the day today. Thank you all for wearing masks. Again, we continue to appreciate your willingness to wear masks. Just a reminder to keep snacks out in the hallway. You can, take sips of coffee and water if you need to, but we ask that snacks stay out of the room. And with that, I will get to the good stuff here. So I think we all know that carbon and ecosystem service markets are a hot topic right now, and I'm sure some of you are finding out it's a bit like the Wild West out there when it comes to carbon markets. So I am very happy to welcome Dr. Alejandro Plastina, who is an associate professor and extension economist with Iowa State University, here today to help us navigate these tricky waters. So you can take it away.
Thank you very much, Jorgen. And good morning, everyone. Glad to be here. I would like to explain a little bit our perspective on this Wild West situation. It is like that right now. And you notice that I shortened the title just to carbon markets because that's what people talk about, but it's carbon and ecosystem services markets. So just a disclosure, I was awarded the 2021 Agricultural Economics Fellowship by the Farm Foundation to study carbon markets. So this is part of my program with the Farm Foundation too. So you probably heard about carbon markets recently. And can everyone hear me okay back there? Great, thanks. Just checking. We heard about carbon markets a lot on the news as of recently. Let's see, by a show of hands, how many of you have been contacted by a carbon program trying to invite you to participate in their projects? Okay, maybe 5%, 10%. Well, carbon markets are not new. In fact, if you take a look at the Google search webpage, it says that they are carbon neutral since 2007. So somebody's been paying attention to this much longer than we have, right? In Glasgow, we had COP26 celebrated recently, and both developed and developing nations agreed on standardizing the rules to generate these carbon credits and trade these carbon credits. So that's something very important looking for the development of this market. Microsoft and many other companies like JP Morgan, many banks, many large companies have already pledged investment in carbon markets and ecosystem services, Microsoft being the largest one, and they usually talk about these explaining that they will become carbon neutral or carbon negative by some future date. 2030, 2050, 2060, there's a lot of investment behind these carbon programs. And there are a lot of companies that are capitalizing on that are monetizing this interest by providing a platform to trade those credits. Nori is the company that's been in the market for the longest time. They celebrated 4 years, and I don't know how many of you knew that you can go online and purchase an offset of carbon that maybe you emitted coming here with your truck, or you contributed to the environment while flying to your vacation in Florida, let's say. Well, you can actually offset those emissions by going into Nori.com and purchase carbon credits. They will do the calculation for you on how many kilograms of carbon dioxide equivalent your flight emitted, for example. And you can purchase those credits from a specific farm in a specific place in the United States. And there are farms from Iowa actually participating in this program. It costs about $15 plus 15% fee to do that per unit of offset. There are, and I will discuss this later, there's a big variety of carbon programs right now offering alternative ways to offset carbon programs and for farmers to participate in these programs. An interesting development in the United Kingdom was this label that I saw recently. So that label is a code. It has it's a carbon footprint label going from A through E in categories. So it goes from very low to extremely high carbon footprint, and that's attached to food, to a package of food. So now consumers in some parts of the United Kingdom can decide whether they want to purchase a food product, not just based on the type of product or the quality, but they can take a picture of that QR code and see the history of that production process and a pretty detailed description of the carbon footprint of that product. How much trust I put into that, it will vary from person to person. This is not something that is standardized internationally or anything else. But what I'm trying to say is that there are companies investing money on this. So they expect that somebody will be willing to pay the extra cost, the extra piece of information attached to that label, so they can make a profit out of it. Well, probably we're not seeing these coming to the US anytime soon, but in some parts of the world, that's already happening. And I think the funniest part of the news, as I read about this carbon market, is that big oil is supporting carbon neutrality. And they are, methane is a big contributor to greenhouse gas emissions or global warming due to greenhouse gases. Well, how comes? Exxon, BP, Shell, they are all supporting this carbon neutrality. Guess what? There are big subsidies to be claimed if they do stuff to reduce their greenhouse gas emissions. So they are already investing big into gauging how much greenhouse gases they avoid or they prevent from going into the atmosphere and claiming subsidies for that. So we have a big range of industries behind this carbon market that is kind of new for agriculture, and in particular agriculture in the United States. Why we're paying attention besides all these pieces of news? Well, because now there has been a major jump in the price of carbon internationally. So as of mid-December, that's euros per ton of carbon dioxide equivalent or per offset in the European Union. Those are 80 euros, about $130 per offset. Now, if out of $130, let's say 100 could be brought to the farmer, I guess many farmers would be interested in in changing their practices to access that premium, right? Well, unfortunately, that's not the case, because these prices are for carbon offsets that are mostly generated in other industries, not agriculture. And we'll see why in a minute. But just to have a point of comparison here in the United States, the closest we have to a high carbon price is in the California cap and trade system. Now, California regulates the emissions of power plants, big power plants, so they tell them how much they can emit per year, how much they can pollute per year. And if they go beyond that cap, then they have to buy allowances, unused allowances from other companies, and that's the trading system. Or they can also go and buy carbon offsets from outside of the power industry. Now, who provides those offsets? Forestry, methane capture in livestock production. What about agriculture? Well, agriculture could only generate carbon offsets for this particular system through reducing greenhouse gas emissions in rice production. Have you seen any rice production in Iowa? Not that I'm aware of. But we do have livestock. So even in this situation, the price for a carbon offset in California goes up to maybe $24, $25, much lower than the $130 that is the price in Europe, right? But still, there's a price there, and it's much higher than previous prices from previous years. So that's why we're paying attention to that. On top of that, many countries are adopting new practices, or new regulations, I should say, that target greenhouse gas emissions. And this chart, I've seen many versions of these charts. This is from the Wall Street Journal, in many other newspapers. This shows the share of global greenhouse gas emissions covered by carbon pricing initiatives. That means that either through voluntary or mandatory programs, governments and the private sector are paying a price for emitting carbon or mitigating the emissions of carbon. And it can be like the California cap and trade system. It can be like a carbon tax where the polluter pays for the polluting, or it can be other methods. But that started very low in the early 2000s. Now 21.5% of global greenhouse gases are under some kind of carbon pricing scheme. And that's good because we have a price for carbon. And that gives signals to producers and consumers around the world about the cost of that carbon. So prices are going up. There's a lot of interest in carbon market, in carbon pricing. Can we expect a wave of demand for carbon offsets from agriculture? Well, maybe, but we have to be aware that agriculture is mostly an annual production. That's very different from forestry. Long period, long-term production systems. And with annual productions, you can change practices from year to year, while if you plant a tree and that tree stands in the field for 30 years, it's pretty easy to track the growth of that tree through satellite imagery. You don't have to have someone checking on that particular plot like we probably do to track practices in agriculture on an annual basis. That contributes to the fact that there are different types of carbon credits or carbon offsets that can be generated through different industries. And in the end, the consumer, let's say the Microsofts of the world, or that family that wants to offset carbon credits, carbon emissions from their trip to Florida, they, at some point in time, will pay attention to the quality of those carbon credits. So what determines the quality of a carbon credit? You cannot really eat, touch, smell, see a ton of carbon dioxide. So what's really important is for the buyer, again, for the buyer, what's really important is that the carbon removed from the atmosphere be directly linked to the payment they make for that particular carbon offset. And that's called additionality. We'll see about that in a minute. The other thing is, if you think as an investor or as a farmer, think about your equipment. You don't want that equipment to lose value very rapidly. Well, an investor, let's say Microsoft, buying these carbon offsets, they want to keep those assets in their balance sheets, and they don't want those assets to lose value rapidly. So one important characteristic of high quality carbon credits is their permanence. For how many years carbon sequestered at a point in time remains in the soil or somewhere else instead of going back to the atmosphere. So permanence is the other characteristic that determines the quality of a carbon offset, and therefore is related to the price that consumers are willing to pay for it. So agriculture has the potential to produce on an annual basis lots of carbon offsets. But the value of those carbon offsets, once those get to the market, will be determined by the competition, not only by demand, how many people are willing to buy those carbon credits around the world, but also by competition with carbon credits generated in other industries. Think forestry, like I mentioned, or industrial processes. Let's say capturing gases emitted in the combustion process or in the production process of ethanol, for example, liquefying that carbon dioxide, sending it through a pipeline, let's say through 30 counties in Iowa, and injecting that liquefied carbon dioxide into a bedrock or a cave several thousand feet under the topsoil, and then leaving that liquid to solidify over centuries into rock. Well, that's a pretty big process, but once that investment is done, the cost of operating that process annually is very small compared to the initial cost. And one thing is that it's very easy to measure changes in gases in an industrial process because there are plenty of gauges to do that. You look at a small gauge, and that can keep track in real time of how carbon is sequestered. And then once it's injected into the soil, that's pretty much eternally in there. That's real permanence. And that agriculture will have to compete with credits from those industries. Yes, sir, you have a question? If it is a clarifying question, maybe you can address it now.
The clarifying question that I have is on quality.
Quality, okay.
Yeah, in your two terms of additionality and permanence.
Yes.
Don't seem to fully capture the value of the quality you're talking about.
Mm-hmm.
And one of the concepts would be provenance. What was that land doing originally? So, for example, if I take an acre of rainforest, cut it down, and now I'm turning it into agriculture, and now somebody's going to pay me to store carbon in the soil, we're not reflective of the quality of what just happened to that acre of land.
So great question. How does, what word you use?
Rural wetlands. You have to
Yes.
the provenance of a piece of art. You got to think about.
Yeah, how does the quality of a carbon credit relate to the history of that plot, basically? If the plot was, rainforest in the Amazonas, and that was slashed and burned to do agriculture, and then you start paying those farmers to capture carbon or other greenhouse gases, then is that a high quality carbon credit. That's where the question is going.
And there's one other aspect that I have not heard anybody else talk about, at least in my discussions, with respect to quality. It's because we're thinking about carbon just as a molecule and that we want to take out of the atmosphere. And we have a price to do that, but we don't think about the difference between price and value. Price being what you pay, value being what is delivered for the price you pay. In agriculture, when that carbon goes into the soil, it delivers additional value that the carbon going into the bedrock, the North Dakota, doesn't.
Yep.
So,
Yeah. So, great.
introducing those ideas.
Yes.
I don't know if you're
Yes, okay, thanks for bringing those up. So one is the history of production in the plot, and the other one is the co-benefits of generating carbon removal or carbon sequestration. Co-benefits being, biodiversity, improving biodiversity, or generating improvements in water quality, water quantity, and so on, and other co-benefits. So let me address the first one, history. Well, history that is being considered under these carbon programs, at least those that I'm aware of, and I've studied about a dozen of them, mostly here in the US, they look back at the history of the plot for 10 years. So if something happened like wetlands, if there was a conversion from wetland to agricultural production 20 years ago, that will not be taken into account. If that happened over the last 10 years, then that will be taken into account when deciding the quality of these carbon credits. The other question is about the co-benefits. So will these programs, carbon programs, take into account the co-benefits of sequestering carbon through agriculture instead of doing it through an industrial process where there's no mostly other co-benefit, there's no change in biodiversity or no improvement in water quality and so on. Well, it really will depend on the carbon program we are talking about. Some carbon programs, like the Soil and Water Outcomes Fund from Iowa, the Soil and Water Outcomes Fund will take that into account and make payments to farmers based on both carbon and ecosystem services. Other programs just pay attention to the calculation of the carbon sequestration. Don't pay attention to ecosystem services. So it really depends, and there's a big menu of programs out there. Okay?
One of the key concepts that's missing is the idea that location matters. Location matters both to the buyer, it can matter to the buyer, and then where the carbon is being stored. And so if we begin to think about these markets in a way where the buyer and the seller can get together in your outcomes fund, I think that's part of that. That I think is going to be really important when you start thinking about carbon that goes back to the soil for agriculture.
So location is a concept. Yeah. Okay. All right. Yeah. Okay. We can go into that at the end of the presentation. But thank you for your contribution. Location should matter. That's the proposal here. So looking into agriculture, going back to carbon sequestration or removal through agricultural production, we know that it has already competed against other industries, and you see there forestry has been the #1 producing of carbon offsets around the world, and agriculture is only in the bottom half of the table. Well, we talked about the carbon credit, but we haven't defined it. What's a carbon credit? It's basically like a certificate or a tradable asset that gives the buyer the right to release or emit carbon into the atmosphere, carbon or any other greenhouse gases. And here everything is translated into carbon equivalent units based on their global warming potential. For example, nitrous oxide, that is the main emission from agricultural production, resulting from the application of fertilizer, the needed fertilizer to the soil, has a global warming potential of about 300 times, 298 times the global warming potential of carbon dioxide. So when making the translation, those conversion units matter. And nitrous oxide is the top greenhouse gas from agricultural production, annual agricultural production. The way these certificates are produced, are issued, is based on the change between a baseline, the gap between a baseline and a projected new scenario based on the changes of practices that would allow the farmer to emit fewer kilograms, tons, pounds of carbon dioxide equivalent. But it's important how we set up that baseline. So what are the practices that usually these carbon programs take into account calculating the generation of carbon credits? Moving from conventional tillage to reduced or no tillage, reducing stocking rates on pasture, the number of animals per acre, planting cover crops, planting trees, reducing fertilizer rates, and converting marginal cropland to grassland. Those are the typical ones. There are other, but these are mostly covered by all carbon programs out there. And you will see that the first word in each of those lines is a verb. It means that farmers need to change their practices. And not only that, but we talked about additionality. So the timing of that change matters. If someone, the buyer requires that their payment be used to change practices. If someone's been doing no-till for 10 years, then that plot will not qualify to generate carbon credits associated with no-till. It can generate carbon credits based on the addition of cover crops, but no carbon credits will be calculated based on no-till. Why? Because of additionality. That's what determines the quality, one of the characteristics that determines the quality of a carbon credit. It's unfair for those who've been doing the right thing for a long time? Yes, it is unfair. But it's a market. It's not supposed to be fair or unfair. I'm sorry. But, you know, it really is a problematic issue. And what carbon programs are doing is offering a 2 to 5 year look-back period. That means that they will not be able to pay for carbon credits on practices that have been going on for a number of years, moving into the future, but they are willing to recognize some of the carbon credits produced over the past 2 to 5 years, depending on the carbon program, for those who have been doing the right thing for many years, okay? So, and that's an incentive that is available right now. I'm not sure, there's no clarity on whether those incentives will remain as this market grows. Right now, the market is at a very early stage, so all these carbon programs are doing two things. One thing is that they are trying to convince investors, angel investors, that their program makes sense and that they will make money out of the investors' money. And they are also trying to convince farmers to participate so they can kickstart the process to generate carbon credits and also tell the story to their investors. But everything is very early stage right now. The other big the other big characteristic that determines quality is permanence. And permanence is really in the eye of the beholder, like beauty, right? In this case, they care different carbon programs will define what's permanent differently. Some carbon programs think that permanence is assured by a practice that does not, once it's implemented, does not revert back to the conventional way of doing things for 10 years. Some others think of permanence as a 20-year process. Some others think of a 100-year process. And that's not standardized. Anybody can claim that their own carbon program is thinking about permanence in different ways. And farmers, of course, once you, let's say if you are working with a program that thinks of permanence as something that, you know, for going on for 10 years, and you sign to switch from conventional tillage to no-till for 10 years, let's say in year 5 you have a bad weed infestation, you need to till, chemicals won't do it, so you need to till. Well, that's called a reversal. By just tilling that soil one time, about 40% of the carbon sequestered through previous years will go back to the atmosphere. Well, that's a reversal, and carbon programs will penalize that. How? Well, as far as I know, they will not, they will suspend payments until that, that carbon is put back into the atmosphere. And then you'll start collecting payments again. But those reversals are important if you think of signing a long-term contract. And finally, going back to the fact that carbon dioxide cannot be tasted, touched, smelled, or anything, in order for this carbon to exist, we need a strong MRV system, measuring, reporting, and verification system. Think about going to a restaurant and you ask for a salad, and you get the check. The salad was twice the price that you thought you were going to pay. You ask why, they tell you it's an organic salad. How can you verify that that was an organic salad? You cannot say by the looks or the taste of it. You would have to actually see, either know the farm from where that is coming, like many of producers here in this conference, or you need to trust the label system. You have to be able to see that USDA organic label or a similar label in order to decide whether you are willing to pay for that organic characteristic. Well, same thing with these certificates or these carbon credits. You need to trust the system in order to be willing to pay for it, right? It's an asset. If we don't have strong MRV systems, this will go nowhere. All right? We are at the very beginning stages of the market development because we have many different platforms, many different programs, and these programs don't talk to each other. They have different ways in which they measure carbon removal. And that's, you know, it can be traced back to the models that they use to measure carbon removal. And these models are very different. They don't have conversion factors that we can all use and say, okay, if I'm with carbon program A and I do no-till, I will get this many carbon credits. If I go with carbon program 2, same practice, same field, will give me about the same number of carbon credits. That's not the case. It can be very different across carbon programs. The same farm, the same practice, same farmer, very different carbon removal results, outputs. So, but this is where the system is right now, and it's, you know, it's at the very early stage of development. Now, if this had been any other proposal or, you know, opportunity back out there, like we saw with hemp a number of years ago, I would probably say, that's not a profitable route. And And in fact, that's what we were saying, the farm management team were saying back when hemp was all over the news. We said, don't go that route. So far, we've been right in Iowa. And up to this point, I would say, it looks like the hemp route. But big difference between the hemp opportunity and this opportunity. Look at all the companies that are supporting these initiatives. And this is just one carbon program with all these many companies funding, investing money, their own money, to make it work. And this is the ESMC, we'll see that in a minute. Big names right there, and even input companies supporting this. COP26, where nations talking about standardizing the rules so these carbon markets can grow. So we have to see whether they will thrive, but they will grow in the short term. One way or another, there's too much money behind these markets for them not to grow. So how is a carbon credit generated? And I will try to tell the story so we understand what farmers are up to when they talk with carbon programs. Okay, so the traditional way of generating these carbon offsets is we start with a protocol, a recipe developed by a registry. It's a private company that they say if you follow this recipe, then you will generate carbon offsets, and if you keep track of these indicators, then you will be able to claim that what you did in your farm can be audited and can be translated into a carbon credit that is issued by the registries. The role of the registry is to provide the recipe and then to issue the carbon credit. What is a carbon credit? How do registries issue a carbon credit? Well, in the end, they generate a serial number or a QR code, if you want to think of it that way, that goes into a ledger, and that QR code and serial number are associated with a lot of information about practices put in place in a farm and audited by this and such. And therefore, so many carbon units of carbon have been removed through that process, and that's a serial number. In order to translate the recipe into the actual issuance of the carbon credit, there are project developers, private companies also, that take the recipe and try to apply the recipe in a local environment working with farmers. So they follow the recipe and add, methodological, they adapt the methodology to make it work for the farmer. Farmer applies those changes in practices and shares data back with the developers on how those practices were implemented. The project developer gives all that information to a third-party independent verifier. Those audits go on, checking that everything was done according to the recipe. The verifier gives the okay to the registry. Then the registry issues the serial number. To whom? Usually to the project developer. Now the project developer, with the serial number in hand, goes to the market and sells it to Microsoft, sells it to whomever wants to buy it. But, thank you. That's one way to finance the entire process. The other, just in a second. The other way is to work directly with investors early on in the process and have they sign this emission reduction purchase agreement. Basically, they finance the entire system and they pay less for the carbon credit than if the carbon credit were sold directly in the market. So that's what this process entails. Yes, there was a question here.
Like project developers, would that be where Indigo or Cargill, like there's
Correct. Yes. So project developers would be Indigo, Bayer, Cortez, you name it. Okay. So not this is a traditional way of generating a carbon offset. Not all carbon programs follow this protocol. And we'll see that in a minute. And also try to look at what farmers can expect from each of these carbon programs. So Agoro. Agoro Carbon Alliance is an initiative by Yara International, chemical input company. And they pretty much follow this standard. And they require a 10-year contract, minimum 500 acres. And the cost, the out-of-pocket cost for the farmer is the cost of implementing the practices. Now, farmers will have to upload their information into the Agoro platform. This is an online platform, and most carbon programs will require this interaction, uploading some information to a website. And Agoro is thinking of a 10-year permanence system, and they will retain 20% of the carbon offsets in the case there are some kind of reversals. Now, very different system, the Soil and Water Outcomes Fund. This is a spin-off of the Iowa Soybean Association, and they have everything in-house, issuance, verification. They follow the Comet Farm method, and they are requiring just annual contracts, no minimum. And do you know how much was the average payment per acre last year? And they take into account both carbon and environmental services. That's different from other programs. $33 per acre. That was the average payment from this system last year. And it goes from anywhere from $10 to $40 depending on the farm. So very convenient for the farmer. Probably not the not the highest quality carbon credit out there. But that's a problem for the carbon program, how to sell those credits. The farmer on annual contracts makes sense to participate probably in this system. Another, the ESMC, they follow another methodology, denitrification, decarbonization model, and Optis. I can't remember, probably Marshall, you know what Optis means, but I can't remember right now what. Yeah, it's another model, so different from the previous ones. I'm sorry to bring you to spot, but the idea here is that we have different carbon programs using different models to account for these carbon credits. 10 years, there's no minimum area there. Indigo, the lady mentioned Indigo here. Well, they work with Vera and Climate Action Reserve. They keep in a buffer or a pool 5 to 20% of the credits, just in case there are reversals. And farmer Indigo pays up, at least 75% of the sales of these carbon credits back to the farmers. They require a 5-year program. Cortez works as a project developer for ESMC and Indigo. So you see all the intermediaries in between farmers and buyers right here, and they offer a 5-year contract. And they also keep 5 to 25% of the credits for them to provide for in case of reversals. Nori, the online platform, they sell the carbon credits but keep some undisclosed amount of that sale in a cash reserve for 10 years. So farmers will receive the payments annually, but some portion they will only receive after 10 years of finalizing the contract with Nori. And that's because they think that permanence must last for 20 years. Sibo, they follow another method, Salus model, and they issue the carbon credits directly to farmers. Not to themselves, but to farmers. And farmers decide when to sell the carbon credit. And they have 1 to 10-year contracts, and they retain 20% of the credits. Gradable, another carbon program, they also issue credits to farmers, but they retain 40% of the carbon credits. 15% as fees and 25% are retained for 100 years. Talk about permanence there. They offer 5-year contracts. And Bayer, they are registry agnostic. That's what they tell me. They work with all kinds of institutions. And farmers are paid on an per practice basis, not per carbon sequestered, but per practice. $3 per acre per year if you do no-till or strip-till, and $6 per acre per year if you do cover crops, $9 if you do both. So it's very important to ask a lot of questions when considering whether to enroll in these programs, and it goes anywhere from the contract length, terms, and exit clauses to whether you can stack those payments from, let's say, NRCS, some cost share payment from PFI with payments from these carbon initiatives. And that varies from program to program. And it also makes sense to ask whether they have free customer support to upload that data to their website, and whether they have free agronomic guidance to implement the changing practices they require. So, if we look at the world supply and demand of carbon credits, and this is voluntary carbon offsets, the blue area here represents number of issuances, and that is, let's say, the supply, and the light blue represents the retirements. How many of those carbon offsets are used to offset emissions by some particular company? So that's the demand, the actual demand. What happens when supply exceeds demand? Prices go down, yes sir. So prices are going up right now, but the big picture around the world is that issuances far exceed retirements. Now, the other thing is, I'm sorry these are small numbers, but I just want to point out that looking at issuances and retirements by category, by industry, let's say, agriculture accounts for less than 1% of all offsets around the world. So there will be stiff competition from other industries if we decide as an industry that we want to proceed with these carbon markets. Final words, please do your homework, analyze these from all different aspects possible, talk with your family, your attorney, trusted advisors before signing any of these contracts. And I just want to mention that we do have these charts and more information published in those 2 reports available in the Ag Decision Maker website. So with that, I'll open the floor for questions, and I don't know how much time we have. Yes, sir. 10 minutes, 11 minutes. So let's, you want to comment on yes. Yes, so let's start with the gentleman's question about co-benefits, and the other one, I think, the history, the long-term history of the plot, I think I addressed that. Nobody's paying attention to the history beyond 10 years. So it is what it is.
One other thing. Throw terminology around and it's not very consistent.
Okay.
Talk about a program developer.
Yes.
Okay. Then we're talking about a market. And it's not a universal market. It's what I really liked your presentation. You had my head spinning. So I think it's really important. I guess my question is embedded in this is whoever sets up the market, sometimes it's the program developer in your language of things, has the ability to set the rules. And so I think it's really important. Here in Iowa would be a great example. Talk about additionality and permanence. And one of the things that I've heard, and I agree with it in terms of the equity, paying somebody because they're late to the table, you pay them for the additionality. That makes sense. They're adding to whatever it is we want them to do. But if you go and pay them for the permanence of that additionality, then the person who is already been doing it should also be paid for the permanence. You've got to be able to separate the value attached to the additionality conversion and the portion that is has to do with the permanence. And if we that's my commentary, and any feedback on that
Yes.
idea.
Mhm.
Just because it hasn't been done doesn't mean we can't do it.
Yep. Thank you very much for the comment. So the question, just for recording of the session, has to do with the quality, the value attached to the additionality portion of a carbon credit, and the value attached to the permanence of the carbon removal or sequestration. So from an investor perspective, the additionality value seems reasonable in this conversation, but is there a way to attach value also to the permanence in a way that those who have been doing these practices for long term can be paid to maintain or to expand the permanence of their carbon sequestration, basically? And the answer is, and all this in the context of not a common language and not a common unique market for carbon credits. So let's start from there. There's each of these program developers are creating their own products, and there's not a clear price discovery process. So basically, if you want to buy carbon from Nori, you can go online, and that's pretty transparent to the buyer. But all other companies are keeping prices, the prices that they receive when they sell these carbon credits, those are not public. We know up to a certain point how much these carbon programs are paying to the farmers where the carbon credit is originated, but we don't know how much money these companies are making when selling the carbon credits. And guess what? My guess is that they are not making any money so far. Why? Because they are living off angel investors. So all these companies have larger companies behind them investing money in developing the practices, in developing the methodologies, in testing priorities, so they can become profitable down the road. Right now, it is my understanding that all these companies are on a pilot stage, on a piloting stage. So although we have all these commitments and pledges by big companies, corporations, governments, to do things, you know, to achieve a certain goal 10, 20, 30 years down the road, right now, those investments are promises. And to the specific of the price paid by different players for carbon, there are a number of online markets where you can track the price of carbon in that online market. But again, there's no one. There's not a single, standardized contract or futures contract to do that. So if you follow the ICE, you have the European Union contract. If you follow, there's a market for carbon credits in cryptocurrency. They do have a price, a daily price. There's the NGEO, just like that, futures contract in the Chicago Exchange that does provide a daily price for futures contracts on carbon credits. But the problem with those contracts is that they're very illiquid. So there's not much trading going on behind those prices. So they are not representative of anything in reality. They are like everybody else, they are trying to set a product, set a service, and hope that that program or that service will grow and will be profitable. Right now, everything is on a piloting scale. So that's the problem. One of the problems of these markets. Now, going back to the additionality versus permanence, we don't really know how these prices are set, or even how what's the average price across these carbon programs. We don't really know how much is coming from the additionality part and how much is coming from the permanence part. I would say that it makes sense to expect that eventually more permanent practices will bring higher prices, and more additional practices will bring higher prices. But at this stage, my take is that all these markets are financed through angel investors, basically, risk capital. Yes, you're. Okay, Marshall first, and then the lady in front. Thank you. You bring a great question about the data, the flow of data back to these companies, the project developers, and then the registries. Well, that's a big question. Right now, the only program developer that has some protocol that is, I can't remember the exact name, but it's a certified protocol. Think of like an ISO protocol to manage data and privacy of the data, is Indigo. That's the only one I'm aware of. But that, managing data correctly doesn't mean that data is not going to be sold down the road. So, and I agree with you, there's value in that data that so far these carbon markets are not recognizing or are not paying for. But I think that's a critical issue to take into account. Yes, these are annual practices, right, that farmers would have to report back to the developer, and soil test results. And that's, that could be troubling. The lady here in the front, you had another. So, yeah, I couldn't hear the question itself. Thank you for your comments. And
so who do you think should be defining the quality of agricultural credits specifically different than forest credits?
Okay, great, thank you. So the question is, who should be defining the quality of or the permanence of agricultural practices to generate carbon credits? Honestly, I don't know. I can say that the Senate, the U.S. Senate, passed in July 2021 the Growing Climate Solutions Act, and that's been approved by the Senate. And there, the Senate requests that USDA forms an advisory panel or advisory committee, not to regulate, not to get into these markets, but to have farmers, mostly farmers, followed in representation by industry members, and then followed in the number of representatives by researchers and mostly researchers. So then they can develop standardized rules about what's considered a good quality carbon credit. Pretty much like they did back in 2001 with the organic labeling. Prior to 2001, there were so many labels claiming organic production that it was useless to have all those labels. Now, after 2001, with the USDA organic, there was a niche market, but a valuable niche market on organic. I think the goal of the US Senate was to create something like that to help the industry develop a convenient labeling MRV system so the carbon developers can agree on what's a minimum quality carbon credit. And from there, you can then develop futures market and futures contracts and so on. But that standardization is not there right now. And it will be hopefully revised by the House this year.
Well, unfortunately, we are out of time. I'm sure that Alejandro will stick around for a few minutes if you want to come pick his brain.
I'll be around. Yep.
But don't forget, the lunch is upstairs, starts in half an hour on the 200 level, and please remember to fill out an evaluation. Thanks, everyone.